This is CA Ragini Goyal from the Guwahati branch EIRC of Icai Eye. I welcome you all to this first technical session, which is a panel discussion on new age financial assets. I am glad to welcome you all to this session. As we all know that we have been running a little late, so we will run a little faster so that we do not miss any of our buses ahead. So, first of all, let me welcome CA Ayush Jain, who's the convener ACAE CACP Study Circle. Please join me on the dais, Ayush Jain. Now I take the privilege to invite the esteemed panelists, and first I would like to invite CA Vinod Kothari ji to the stage, who is our eminent panelist today. The second eminent panelist, Shri Anshul Jain, Executive Director and Head of Investments, Avendus Credit Fund. I also take the pride and privilege to welcome CA Anup Kumar Agarwal, International Finance Corporation South Asia FinTech Lead. And last but not the least, I welcome esteemed moderator of this session, Mr. Rakesh Soni from Times of India Group, Corporate Director. We have all these personalities who need no introduction. When they are on the stage, we better make way for them to speak and we listen. That is the honor of the day. So with this, may I now first do the honors to the speakers, and may I invite the regional council members present to help us in felicitating the eminent panelists and moderators with a traditional welcome. May I request the team backstage to help us in felicitating our panelists and the moderator of the session. Let us give a big hand and welcome the eminent panelists who have made time for us. Welcomes be a little more warmer, please, so that it gives us the energy and the presence of mind to listen to the discussions which are coming ahead. So we welcome Soni ji, who is the moderator today to this session of ours. Assets are something we all love. And when it comes to the new age assets, let us hear it from the experts, because everybody loves something that is new, right? Change is the only constant, and when the new replaces the old, it is always tempting, it is always attractive, and it needs to be learned after unlearning what we have learned for so many years. So, sir, Mr. Rakesh Soni, I welcome you, sir, and the panel is all yours. So, I invite you for your moderation on this panel discussion, New Age Financial Alternate Assets. Thank you.
Hello. Yeah, thank you very much. I think we have a huge crowd to address, and so we should not delay any further. I'm sure they are very hungry. So guys, thank you so much. Thanks to everyone who was there on the stage 10 minutes back. There were so many of them, so I thank all of them to make us, invite us to come here. So my topic today is very simple. The topic is what is happening in the country. And we all know that we are a $4 trillion economy and we're going to become a $7 trillion economy very soon, and by 2047, we will be a $30 trillion economy. I'm sure all of must have heard about a lot. But being chartered accountants, I think that question always comes to us, that how the hell this is going to happen, right? In order to grow an economy, you need capital, and there are various means of capital that one has to raise. And one of the very important asset class which has been investing in this country is the alternate asset class. So my topic, presentation please, today is about alternate investments in India. So if I have to invest, now if anyone wants to invest in the country, there are various ways of investing. The first and foremost ways of investing is in the markets, which is capital markets, right? Where you invest through mutual funds. And in capital markets, you are actually buying assets of someone else. It's a secondary transaction that keeps happening, right? Someone sells the shares and you buy the shares. That money is actually not going for the development of the country, or because of that investment, the GDP of the country will not increase, right? Because someone is selling shares and someone is buying shares. So who will contribute to the growth of the economy is what we're going to talk about, and that is what is called alternate investments. So today, alternate investments in India is close to $140 billion, which translates into about 12.5, 13 lakh crores. So, if I go, so this is a chart that shows you that we have 13 lakh crores of AUM, asset under management in the country, and that is what we will talk about. The four people that I have, I have Anup Agarwal, who is the capital provider. Anup is from IFC Washington. IFC Washington, as you all know, is one of the world's largest global capital provider in India, and they have been in India for over 50 years. And Anup has led this journey for the last more than 20 years, and he can tell us how this market has emerged over the last so many years. I have Anshul on my right. Anshul belongs to Avendus, which is a domestic capital provider, and Anshul is part of the private credit. Anshul is going to talk about private credit to you guys. Vinodji, I don't have to give his introduction to all of you. We all know him so well, and he has a ringside view of all the regulation that has shaped this industry over the last so many years. I am Rakesh, and I have been very lucky that I have been part of all the organizations, because I used to work for a global fund, I worked for a Desi fund, and I've also worked for a corporate. So I have seen how different asset classes have performed and what has driven this particular asset class over the last so many years in the country. So without any further ado, sir, to you, if you had to describe the state of India's alternate asset ecosystem in one sentence today, what would it be?
I think it's a vast developing country, and we have large ambitions, and the country needs capital, the country needs debt, and the country needs investments in infrastructure, the country needs investments in commercial real estate. Therefore, we have all kinds of instruments today. We have alternative investment funds, we have the online bond platform providers, we have infrastructure investment trust, we have real estate investment trusts. So we have a complete combination of people who fulfill the aspirations of this country. That's what I'd like to summarize.
Wonderful, sir. Anup, you have been part of IFC Washington and largely been contributing to the private equity world. And as we all know, out of the $140 billion that I just mentioned, almost 60% of it comes from private equity. So what is if you can just give certain examples of how private equity has been able to build businesses in India, and you have been part of so many of them. I think that will be great for our viewers.
Yeah, thanks, Rakesh. So, first of all, whatever I'll share here, these are my personal views, just wanted to mention. Other thing also that I wanted to mention, because since we are talking about asset classes and investments and all that, we are not recommending anything. Just don't get carried away in terms of making investments. You make your own choice, take expert advice, and so on and so forth. Having said that, working in a DFI, one thing that I realized that if you have to create new businesses, then somebody has to take risk for supporting those new businesses. And if I go back, let's say 28 years when I started my career, then I used to only hear about banks, where you can get loans. Maybe some state development corporations were there who would provide some capital, initial capital. But it was like private equity, venture capital was not so popular then. Very few, maybe some foreign funds were there, here and there. But in the last 10 years, things have changed significantly. And which has actually resulted in creating a huge startup ecosystem. And not only foreign private equity VC funds are there, but now we see a lot of homegrown private equity VC funds. Now, having, in terms of the supply of capital, that has got created, people who can provide risk capital, and how that helps in terms of creating businesses. Now, when you see some of these small businesses, and some of them, I have been part of investing in different parts of the country. I don't want to name them because some of them are listed. So I'm avoiding names. But these entities were very small when we invested in them. And they were struggling to get adequate capital to grow their business. On the other hand, there was a huge market available, where the demand was there in terms of, let's say, taking loans or, some other types of financial services. But these companies were not able to provide them the product that they needed. Now, what they needed was somebody needed to put some risk capital into them. And then as a DFI, we came in, we provided those, whatever initial capital requirement was there. After we came in, a lot of other private equity funds came in, they provided, and some of these businesses actually grew over a period of time. And the size has, in terms of size of businesses, these businesses have grown almost 100x in the last 15 years. So without capital, they were stagnant. Once capital came in, the right management was there, right business model was there, market was there, and they started growing phenomenally. Yeah. And today they have become huge. So the point is, and like this, there are many, many, many stories which we can talk about.
Yeah. No, Anup, I think you are bang on. So if you look at this chart on the back, the share of AIF today in India GDP is only 4%. And, you can look at the share of term deposits is much, much higher. Globally, the share of AIF in global mature markets, which is US and Europe, is more than 20%. So Anshul, to you, if we have to reach that 20% mark, what are the key drivers you think will play a huge role? Is it liquidity? Is it growth, innovation, return? What are the factors that you think is required to make AIF 20% of our GDP?
No, I think, see, all of those factors that you mentioned, which is liquidity, regulatory framework, governance, I think these are the building blocks for each and every asset class, right? What's happening with alternate today, and alternate has, as you mentioned, there's private equity, there is real estate, there is private credit. Private credit to that extent is the newest addition to the alternate family. Now, one thing which will actually help in terms of getting more attention and more liquidity into this is basically education and awareness about it. And I'm talking more both on the supply and on the demand side, right? Today, I think as Anup mentioned, it's only in 10 years that you started getting those customized capital or a suited capital which is required to fuel the growth of all the companies, right? And especially the mid-market ecosystem, I would say. Because large corporates always were flushed with liquidity. They were banks, they were other NBFCs who are providing the capital. But to the mid-market ecosystem, which is going to be the accelerator for the entire economy in the coming years, I think for them, this whole category has to come in, which has started coming in the last 10 years. People are getting more aware about what this capital is all about. What are the risks, what are the nuances, what are the return profiles, what are the other risks associated with this capital, both on the supply side who are investing it, and I think also on the demand side, where corporates are now knowing that this is some capital which is now available, which was not the case 10 years back. So my sense is when people both on supply demand side are becoming more aware and educated about this asset class, this is going to be one of the factors which will fuel the growth of AIFs, as percentage of the total investment.
So Anshul, you mentioned about performance credit, and that is what you manage. I think most of our audience today are aware of private equity and real estate. I think performance credit is something little new to the audience, and it is a newer asset class, as you rightly mentioned. Yeah. Can you really deep dive in terms of what performance credit is and what kind of assets can be acquired? What kind of companies can actually go? What is the tenure of performance credit? What is the coupon rate? What is the structure? If you could
Sure.
just quickly take us through that.
Sure. So as I said, I mean, this is the newest addition into the entire alternate world. Let me put it this way: this is the newest kid in the town who's everybody's talking about, but many people don't know in terms of what actually this is. So I think rather than only talking about performing credit, let me use the word private credit, because that's a larger word and that's the buzzword around the entire market today. So see, if we go 10 years back, right, and look at the traditional sources of capital for any company, there was bank debt for, let's say, which will hover around between sub 10%, 8 to 10, 7 to 10%. Then you may have mutual funds in NBFC, which will probably play around 11 to 12%. And then if these two sources are not available, then the next source of capital that you can anticipate would only be equity, which will start from 22%, 24%, right? So this whole space between 12% to 22% was absolutely missing. And that's exactly what private credit as a capital pool has come and filled up, right? So on a very high level definition, anything which banks can't do, right, is private credit today. And now this space has filled up in such a way that at every 200 basis points, right, you have a category of a private credit AIF or a capital pool. So 12 to 14, people call it as low yield performing.
Can you give us an example of a transaction where you would have invested and how private credit has actually helped the corporate? Because it is largely a sort of a mezzanine capital that you provide.
Correct.
So if you could just give one example,
Sure.
that will be really helpful.
See, so I think there are two big test cases of this capital. One is in the operating entity where there is a growth capital which is required, right? Now, and then the other test case is basically when promoters actually need the capital or the entrepreneurs need the capital largely to consolidate their own stake, right?
Or they are buying out a business.
Or they are buying out the business, which is typically...
Or somewhere there is a family settlement and you have to buy out your brother.
Correct, absolutely.
And you need your capital.
So, I think the holding company level, I don't think there was any capital available before, right?
Okay.
Operating level situations, yeah, of course, you can have some of the NBFCs coming in, mutual funds coming in, and now maybe for the listed large companies, even banks are now getting allowed to do the acquisition financing. But prior to that, there was nothing available for all of these test cases. So just to give you an example, right, which is a classical case of promoter financing coming into play, we, out of my fund, we did a transaction where there is a pharma company, right? It's a 50-50 JV between promoter and a German partner. And promoter wanted to now buy out the German partner because the second generation was also coming into the business. They didn't want to have that split shareholding, right? Now if 10 years back this was a situation, they would have got a private equity into the play, right? They would have bought the stake and they would have continued. Today what they did is that they borrowed capital from private credit investors, right? They consolidated the entire 100% stake at a very good valuation because that was the JV agreement. And now, in just 15 months' time, they are going for an IPO, right?
At a much higher valuation.
And they bought the stake at 1,600 crores. The valuation, and in fact, as we speak today, this is the opening day for that company for the IPO. The opening valuation is 6,500 crores.
Wow.
So they have made 4x.
So it's a massive unlocking of value that can happen in a corporate.
Absolutely.
Fantastic. Vinodji, from a governance point of view or from a regulatory point of view, how does the entire performance credit works? Are there regulations which are investor friendly, company friendly? Where do you think there could be challenges when it comes to performance credit?
Now, I'll first maybe talk about AIFs in general and then come to private debt
Sure.
or performance credit as you speak. So, number one, for the AIF itself. Now, just to give some context on how the government is receptive to making the environment more conducive to AIFs. In this budget, 2025 budget, I'm sure you might have noted there's a small amendment in the definition of capital asset. You might have noted that the definition of capital asset now says that in case of securities held by a category A or category 2 AIF, the gains on transfer of securities will be taken as capital gains. Therefore, to eliminate any doubts about whether can be still taken as stock and trade, and therefore the profits can be taken as business profits. I'm sure people would also know that there is a pass-through treatment in case of category 1 and category 2 AIF. So if you as an investor are investing in an AIF which in turn has made a gain on transfer of securities, in your hands it would be taken as a capital gain. And I'm sure you understand that if the capital gain is long term, the rate of tax that you pay is only 12.5%. So versus paying 30% plus tax rate, you are paying only 12.5% tax, which is a very, very important change made by the last budget. Additionally, SEBI has constantly been revamping and kind of making the framework more conducive to AIFs. Day before yesterday, there was a major change where they brought a new category of AIFs called large value funds and accredited investor only, AIOF, little tongue twister name, but or accredited investor only AIF, where the minimum ticket size is 25 crores, brought down from 70 crores earlier. And these funds are given a lot of leeway in terms of regulatory restrictions. Therefore, as much as that they can even be structured in units. Structured units meaning what? They can be a senior unit, which is more protected. They might be a junior unit, which is more risk prone. So you can create structured classes also within the AIF itself. In addition, they have permitted what you call co-investment structure by AIF. They also permitted AIFs to buy A- or lower rated listed bonds as well. So SEBI has constantly been making the regulatory environment for AIF more and more conducive. Now quickly about the private credit, which is basically almost equivalent of a lending transaction. If a so-called private credit fund or private debt fund is investing in debt securities, mostly they buy bonds, and the bonds are secured, then the benefit of enforcement of security interest, which is mostly through SARFAESI, will be available to a AIF as well via the trustee. The trustee has the power to enforce security interests. However, mostly, if it's a large acquisition, the last alternative for the AIF might be to move IBC, but IBC is the last remedy. But I think SARFAESI is also available. So basically what I'm trying to say is that over a period of time, regulators have tried to make regulatory environment more conducive. There were a couple of concerns. There was a concern 2 years back by the RBI. RBI found that AIFs were being used for evergreening of loans by banks. And therefore banks, if the banks had an investment or a loan to a debtor company, so-called borrower company, and the bank also makes an investment in an AIF which is also investing in that very debtor. In that case, banks were required to fully provision the investments. That provision now recently in the month of July this year got amended to say banks may invest up to 5% of their net on funds in an AIF without any barrier. If they invest from 5 to 10, they have to make a provision. Above 10, they cannot invest at all. So that's the RBI concern from, bank regulation point of view. Little bit from SEBI point of view as well. SEBI was able to observe that there were so-called regulatory arbitrage being exploited by AIFs. So SEBI also made certain observations which were made last year, and the funds were supposed to give a confirmation to the custodian. That was to be done by April 2025. So in a sense, wherever there are noted gaps or concerns of regulators, they're trying to address them. But in general, the regulatory atmosphere, Rakeshji, to my view, is perfectly all right.
Wonderful. I think that's great to hear that there is enough and more space for AIF to grow. Anup, you have been both an LP and a GP, right? So guys, for your understanding, LP is limited partners. LP is a person who gives money to an AIF, and GP is a general partner who runs the AIF, right? So Anup has been very unique. He has both been LP and GP because he has given money to AIFs and also have been part of an AIF. Do you think the return reward ratio for an LP or a GP in India is positive? And how has been your experience? Because if this money has to grow over the next 4-5 years, the returns from AIF has to beat Sensex, it has to beat any other asset class. What has been your experience, and if you can share that with us?
Yeah, so see, I don't have so much of data AIF wise, so I wouldn't be able to comment that way. But what I can actually share that ultimately returns are driven by underlying asset performance, right? So if the business models are good and the promoters who have set up those business models, they run them in a proper way, they grow the business in a proper way, those businesses over a period of time, they create phenomenal value. Now, if you see from the point of view of an AIF, so on one side there is a provider of capital, there is a fund manager who is managing that money, on the other side there is a business which is taking that money. So an AIF would, let's say, invest in 15, 20, 30 such assets. Now, when some of these assets perform very well, then obviously AIF is able to exit either by selling to some other corporate that particular asset, or some other fund, or taking it to IPO. And then when the realization comes, that money is distributed to the capital providers. Now, what we are seeing that there are phases. There have been phases when some of these, investments did not do so well. But if you see last few years, so many of IPOs have happened, and these IPOs have generated phenomenal returns for the funds who invested in them. And obviously, because the funds made fantastic returns out of those investments, the investors who put money into those funds, they also made phenomenal returns. So my answer to summarize would be that phase-wise, things change. Last few years have been very good. And, it all depends on the quality of underlying business performance, how well they are run and scaled.
Anshul, thanks, Anu. Anshul, performance credit in a way looks as if you are replacing a bank, right? And when you are providing a debt to someone, because it's essentially a debt, there is always a chance of default. Has there any defaults in your fund, or if you can share your experience of last so many years of investing in that space?
Yeah. No, so I don't think private credit per se is really competing with banks, because we're absolutely playing in a very, very different field, right? And very different transactions where banks have their own limitations because of regulations or because of the conservatism that they have, right? So we are not competing with banks. Of course, we are in a territory which is riskier than banks for sure, because we are lending from 12% starting to almost 22%. And for every yield, there is a different risk-based approach. There is different nuances. So we are playing in a territory which is risky for sure, but that's the nature of the game. Now, in terms of, I think as far as our funds is concerned, so touch wood that we have not really had any incidents of any default or delay. In fact, I would say because we know that we are playing in a territory where there is a little bit of a risk. We know that we are not really collateral underwriters, right? Most of the AIFs which are playing, these are more business underwriters, which basically means we are not getting land, building and property against which we are lending. We are lending against the business. And therefore our diligence level, our outlook on the sector, our outlook on the promoter, on the company is very deep, right? It's almost like equity thinking, but doing a debt
your
product.
diligence is equity, but your investment is debt.
That's what I'm saying. Our thinking also and our diligence also is akin to an equity, but our product is debt. So
Super.
That's why I think the chances of accidents are, at least so far, if you see at the fund performances, there have not been accidents so far. And therefore this asset class is doing decently
I think
well.
overall industry has also not seen any accidents.
Correct.
So, a lot of times, when we look at AIFs, there has been stories of AIF building businesses, and there are many. In fact, I think we have experienced in the last 1 month itself, the listing of Grow, which is an AI-funded business, listing of Lenskart, listing of Zomato, listing of so many other businesses. And I think a new category is being formed. I mean, the market cap of Grow was 1 lakh crore, and it was a summation of so many of the broking firms who have been in existence for over 50 years. And Anup, because the largest amount of capital has actually gone into that space, which is fintech and alike, and you have been an expert on that. What is your view there? Will the investment in this space will further accelerate? And what are we looking at? I mean, how large you think the financial services sector, which is already like almost 25% of our GDP, can become in the next 10, 20 years?
Yeah, so see, there are 2-3 big factors here. One, the size of economy we are, and we all strongly believe that we are going to grow phenomenally in the years to come. So we are just, let's say, $4 trillion today. We will one day become 8 and 16, and there is some vision that our government has for 2047, reaching a particular level. Now, no economy can grow if financial services don't grow. Because financial services provide the fuel for growth of the real economy. So that has to grow, for sure. Now, since you mentioned about fintech, fintech has, why is fintech developing so well? And the reason is because the digital ecosystem which has got set up in the country, that has made things much simpler, much faster. Accessibility has improved. More and more inclusion has happened across the country. Different segments of people have got included. Tier 2, Tier 3, all types of people are able to participate. Now, so the point is, on one side we are growing.
But don't you, sorry to interject, but don't you think we are missing the AI movement that is happening in the US and China? And not many private equity investors in India is investing in that space. Not many corporates are, looking at AI as a category or as a space.
So what I am seeing, so there are two parts. Let's say one is development of AI. The other is application of AI. Very clearly, we are seeing in several of these entities where we are investing, they have started using AI for different functionalities or user journey, enhancing user journey experiences. So that is one part which is happening. At the same time, a lot of innovation is happening. In terms of using AI for creating certain types of robots, which could be used in different types of industries. Forget about only financial services. So I don't think, we have missed it as such. We are going to use AI in a big way.
You think we'll be the beneficiaries?
We will certainly be the beneficiary.
Vinodji, if we have to achieve what Anup is saying, do you think from a regulatory framework, from a legal framework, are we prepared? Are we at par with global standards? What are the changes that the fund managers or the corporates need to implement to be able to achieve what Anup just said?
So to my mind, I think there are three parts to the fintech world I can think of. Number one, the payment settlement systems part, where the fintech entities are assisting in payment settlement systems. Second part is fintech related lending, which is so-called fintech digital lending. And the third part, which is data processing. And I think in each of these, at least the regulatory architecture exists. For example, there's an elaborate regulation for payment aggregators, which is basically concerned with payment settlement systems. There is a very robust regulation for fintech-based lending, which is already in form of the RBI's controls on digital lenders. And all the so-called digital lending apps, which you see on the internet everywhere, these are now required to be registered with the RBI, so there cannot be any unregistered digital lending apps which is trying to sell loans. And the third part is data protection, data privacy, where we are, to my mind, we are a little late to start. We have just enacted the law only a few days back. And we still have an 18-month timeline for implementation of the data protection, the so-called DPDP Act. Whereas rest of the countries in the world, I think 90%, roughly 90% of the countries in the world have already initiated data protection laws. So we might be late starters in data protection, but to my mind, I think the regulatory architecture which would hold these developments in good shape in time to come, that's already in good place.
So you're saying after the tech stack, the regulatory stack is in WIP, and maybe we'll be able to achieve that in the next 18 to 24 months.
Yeah, the so-called OCAN, which is also an open platform for development of apps, that's already working. I think for last couple of years it's working, and I think it's doing quite well. A lot of financial players already are a part of OCAN, OCEN, but called as OCAN.
Anshul, from a sector point of view, one spectrum is fintech, which is futuristic and all of that. And what I have understood of performance credit, it is hard brick and mortar, right? Because you can touch and feel the business, because you are, in effect, as I mentioned, you'll take an equity call, but you're actually providing debt. So you need to have hard security. Can you tell us about the sectors that you are looking at?
Sure. So I think most of the, private credit AIFs are all sector agnostic, largely. Unlike equity, which is far more verticalized in terms of, handling few sectors and going very deep. I think the way private credit works is that you have to be more sector agnostic. You may still have some negative sectors. For example, there are many funds who don't do real estate because that's a very different ball game. But apart from that, at least funds like us and maybe our peers are open to look, open to actually do transactions in all sectors. I would say the topmost ones which are now happening are pharma healthcare, right? Second is all your industrials, which includes all your manufacturing, specialty chemicals, etc. And then you have services, right? So we do a lot of asset-light businesses as well.
Wow.
So I don't think it's a question of having more fixed assets or more real assets as a security. The point is that if the business has value, right, and the value is predominantly more shown in terms of the equity value of the business in terms of shares, then I think we are okay to lend against that business value, right?
Understood.
And that's the key difference between all your banks and NBFCs versus private credit funds, where we are more underwriting the business. Right. If we feel that the business has value, we are okay to lend against that business rather than wait for any hard collateral to secure ourselves, right? And therefore, I said that the diligence level is very different.
And just a quick one. As you know, the banks have just been allowed to do acquisition financing, right? How will that impact your business?
So I think it's not really coming in our way when we are talking about more private credit, especially those high yield performing credit funds. It may tinker a little bit with NBFCs, right, which were earlier having this entire pie of doing acquisition financing. Even if you read the regulations on what banking has been allowed, there are a lot of checks and balances they have put in place. You can only do for listed. There has to be certain bit of minimum percentage of equity coming in, so on and so forth. I think it will still eat away a little bit of pie of NBFCs and maybe mutual funds who are all doing the acquisition financing, but to come and really alter our business or our pie, which is more high yield, I don't think that will really happen.
Fantastic. So we will open the floor for questions. We still have many questions that we can talk about. But before we open, I have a rapid fire for all three of you. One asset class that will explode in India by 2030. Anshul.
No, I think you'll call me biased to say that, but I still feel that private credit is one place. And I think even if you look at the data, right, in terms of the percentage share, we are only going to increase and probably eat away a little bit of share from minority private equity.
Okay.
But because also this space is not something that we are taking somebody else's space, right? This space was not there itself.
Anup, what's your view? Like, he's challenging your 25, 30 years of hard work that you have so patiently put in.
Yeah, I would rather put it alternatives. This itself is just starting. Within alternatives, there'll be many asset classes, and within those, there'll be many sub-asset classes.
And there'll be a
I
lot
can
of
go
new
quite
asset
deep,
classes
but I
that
don't
also
want to right now. We don't have time.
He's being diplomatic, but I think I'll agree with Anshul.
Okay, great. One regulation you wish could change tomorrow, Vinodji?
Okay, I think we are largely fine in terms of regulations. I'm not expecting something to change so very, there's no regulatory hurdle I can see. So just that I would say a little more clarity on use of security interests by anyone other than secured lenders coming into SARFAESI Act. But I think in general we are fine. I'm not expecting any regulation as a bottleneck.
How about you, Anu? Any change in regulation?
Yeah, no comments.
Anshul?
No, I think we keep thinking the wish list of what we can actually change is basically flat taxation between debt and equity, which I think the gap is now slightly getting narrowed up with 12.5 coming for unlisted. So we are still far away because all your debt income, which is all interest income, is still taxed at marginal tax rate. So
the last one. Thank you so much, Anshul. I think I want to be the person who should finish on time. So one last point, that one belief about India that global investors must update. This is a good one. I think, Anup, you are the proxy of the global investors in this country. So please.
So I would simply want to say India is resilient.
Resilient.
Yeah, and it will continue to grow. Let there be whatever challenges be,
but see,
we can overcome.
This question that everyone is asking, and in the last 12 months, in fact, if you see the markets have not performed, FIIs has been net sellers, and there has been one point that everybody says that India is very expensive, and that is why one would not invest in India. What is your view on that?
So again, I don't have any market views, but very simply put, the way I see it, the India is a long-term story. When investors put money, they look at relative performance of one market versus other markets, one asset class versus other asset classes. So at different points in time, they see opportunities in one market versus other. They keep on switching. But I believe India will keep getting tons and tons and tons of money.
Wow. Anshul, you have the
No, I
similar
think-
view?
No, I think very well said. My sense is India is in a position where it is hard to ignore for anyone. Any global capital pool, it is extremely hard to ignore India now.
But when you look at China, China is quoting at 13.5 and you are quoting at 26. Now it is almost 100% premium to what China is doing. China is also doing a great job,
No,
right?
absolutely, but I'm saying, see, look at the large asset managers, right? You will never have a strategy where they will put all their eggs in one basket, right? And now if you look at even top 3, top 4 economies where they would think of investing, you cannot have a situation where India is not featuring there. See, what Anup said is right, because see, those guys are, it's not a permanent capital at times, right? All your FIS, they may keep switching from one geography to another basis what's happening in the country. Today, I was reading some report where global capital has pulled out only because they saw that the depreciation of INR has been...
But this chart says something different. This chart says that more money is being put in the market by the domestic investors and not foreign investors. So are they not listening?
No, I'm saying it will take its own time, right? You said what's one change. I think this whole perception about India and the market that we have, right? If you had asked me that question, that what you would want to change in their minds about India, my sense is we are better rated than what our sovereign rating is today. I think we are not really triple B. We are higher than triple B. And I think with time that will catch up because some of these rating agencies do work with a lot of lag effect. But we are much better rated than that. There is political stability, there is governance, there is regulatory framework which is coming, which is all going to be a very long-term play.
Vinodji, what's your view?
I think I'll completely agree with Anshul on that because there are two avenues to international investment into India, partly through GIFT City, which is also doing quite well now. There are more than 300 funds currently active out of GIFT City. And that apart, direct investment, which is also perfectly allowed now, it's fully allowed on the automatic route. So the share of international investors, what is showing in the pie chart, it's, I think if you were to see what it was 5 years back, the number would have been even lesser. So there's a growth there and I think it will continue to grow. It's a growing story.
So the combined view is that we are good for long term.
Of course we are.
So I have a view. I can I also share my view?
Please go ahead.
Yeah, thank you. No, I just wanted to be sure. So I feel the difference that India has is variety. Because no other country in the world offers the variety that India does. You know, you go to US, it's all about AI. And people are already writing the obituary of AI. They're talking about the biggest slump in the US markets coming our way very soon. I think the market corrected by $1 trillion today. And when you go to China, you know, transparency, manufacturing is the only call. There is no consumer, sentiments that prevails what prevails in India. And I would go and talk to the investors and tell them that you should invest in India because you want to be anti-AI. If you want to have an anti-fragility in your portfolio where if something goes wrong to AI, what will you do? You should come and invest with us. So I think not having AI companies in India is an advantage rather than a disadvantage if you ask me. And that is what we should all go and sort of, make a
Not having excessive investment in AI.
Yeah. So I think we are done. Guys, if you have any questions, we have many more. But if you have any questions that you would want to ask us, any of our panels, we're more than happy to take it. Pankaj. One second. Come. We can't hear you.
10-year CAGR.
Yeah. You had shown one slide on 10-year CAGR for US, but do you have anything on Indian alternatives performance?
I think there was one on there. Yellow.
This is one, right?
Yeah.
Yeah.
This is on US.
Yeah, this is US. India is little better than this. So the 10-year data on this one in India is higher. In fact, in private equity is much higher because I come from that space. 10-year returns in private equity is about 18% in India.
My question is to Anshul. Like one of the major hurdles I find in my experience with alternatives is the accountability issue. Like,
can you be a little loud, Ajay?
From my experience, like one of the major hurdles which I find in investing in alternatives is the accountability of the fund manager. Like in many of the cases, like when the investments goes wrong, and many of the cases I have found that the investment has gone from 100 to 0, and still the fund manager had really do not have any answer to those, like why they have invested in those companies. And so what is the accountability for that? Like who stands accountable for that?
No, I think first of all, the entire structure of AIF is being designed, right, in terms of having the skin in the game of the sponsor as well as the fund manager and the fund management team very, very aligned from a return standpoint, right? Now, of late, there have been certain funds which people have been raising where that alignment is going for a miss. So I agree with your concern. There are certain funds which are being raised in the market where there is absolutely no carry system, right? Which basically means that if you underperform, right, there is absolutely nothing which is going wrong for the fund manager and the team and the sponsor. So I think sponsor capital, one part of it, which I think people are putting in more and more, even beyond what SEBI is regulating, to just show that there is skin in the game. Second, they are aligning the outcome of the fund manager and the fund management team with the outcome of the fund, so that at least they are held accountable to the extent of the performance of the fund. So that is there, but otherwise, see, at the end of the day, there are many funds, whether it is equity, credit, everybody is trying to really do the outperformance. The effect of underperformance of a fund is clearly seen in the next fund or the future of that fund manager itself, right? So you may have one accident, and I think some of the funds are, for example, debt funds, they're absolutely running on a very thin margin. If in my fund, even one transaction out of the 15 goes bad, there is absolutely no future for that fund, for the next fund, and even for the fund manager. So I think they know about it. So most of the people that I interact with in the industry, all of them are completely aligned. But if there is any accident or so for any reason whatsoever, then the accountability or maybe the repercussion is with respect to the sponsor who has funded and the fund manager's future fund and the future.
So basically, there is no regulatory, like Vinodji, you should.
There is. SEBI has stipulations on what they call internal control and risk management. But unlike NBFCs or banks which are very, very tightly regulated, the regulatory framework for AIF is much, much lighter. It was drawn for hedge funds. Hedge funds world over have been very lightly regulated. So now that funds are investing in loans or private credit, yeah, the regulators also need to learn that there is a modest dose of regulation also has to increase. As it stands, SEBI regulations are quite flexible, but recently there have been a couple of adjudication orders. You would probably see some orders of August 2025, where 2 funds were prosecuted for wrong investments. So I think regulators are slowly but certainly getting sensitized to the need for better controls on the fund managers.
And I think the nuance there is, sir, you know, whether anything which happened to the fund was more because of a governance issue, right? That I think is very clear. One is more credit issue that you know, your gut feeling or your intuition or your diligence, etc., for a particular credit or for equity investing was not really up to the mark. But the other faction is that was there any, you know, unlawful practices being done?
Conflict of interest, basically.
Exactly. So for that, I think the regulation is very tight. I'm only talking about the first part of it, where it could be only because of the investing style or maybe the risk-based approach which the fund manager took.
Acha, Vinit, yeah. We can only take one question because, yeah, Vinit, please go ahead.
So any views of the panel on Bitcoin as an asset class?
Which fund?
Bitcoins as an asset class?
Anyone has a view?
Too risky for us to comment.
I think that was a good question. That was one more question someone is asking, so we'll take that as the last. Please go ahead, sir.
Good afternoon, everybody. Actually, in the Eastern India, there is healthcare is underdeveloped.
Okay.
The existing domestic fund and international fund, what are the schemes they have to develop the Eastern India healthcare?
No, it's a good question, and I can only tell you that there has been a lot of investment that has already happened in Eastern India as well. Like, you know, Manipal Group is now very aggressive. They have acquired assets here, and couple of large hospitals actually, like for example, Medica was actually set up by a private equity fund. I don't know how it is performing today, but healthcare is a sector. Like for example, the other company that I can think of was Suraksha Medical, which was again funded by a private equity fund. So AIF has been investing in healthcare in a big way. In fact, after financial services, consumer healthcare is the largest sector. And you will be surprised to know that the largest hospital chains in the country are actually owned by an AIF today. Like Max Healthcare, you have Fortis, and now Manipal is largely owned by NIIF. So sector-wise, it is up the chart. Now you need entrepreneurs, right? You need people to be able to build assets where one can come and invest, right? They cannot come and build greenfield hospitals here in Eastern India. You need entrepreneurs of this part of the country to go and say, hey, I would want to build healthcare infrastructure. Will you be keen to invest behind us? And the answer is yes. Thank you.
Thank you.
On the part of all of us, big acclamation for Rakesh ji, who's working relentlessly for last 3 days.
No, it is.
Thank you very much.
Thank you so much, Vinodji. Yeah.
Thank you so much to the panelists and the very, very enthusiastic moderator. I'm really grateful, sir, that with the lean audience that we had, you built up the momentum and you did a thorough justice to the session. We now have audience coming in after a sumptuous lunch. So we'll have a quick dance performance for a few minutes to warm up for the next session. Before that, I'll just request Ayush Jain to please offer a formal vote of thanks. Thank you.
Good afternoon, respected dignitaries on and off the dais, distinguished speakers, moderator of the session and fellow delegates. On behalf of the Eastern India Regional Council of Icai Eye and the organizing team of the Golden Jubilee Conference, it is my privilege to propose a formal vote of thanks for this deeply insightful technical session on new age financial assets. Alternative asset classes are no longer alternatives, they are becoming a core component of the modern portfolios, challenging traditional models and reshaping how value is discovered and managed. To put the scale of shift in the perspective, India's alternative investment funds have crossed 13 lakh crore in cumulative commitments, with 5 years ago, this figure being around 3 lakh crore only, making it one of the fastest growing AIF markets in the Asia. With these words, I extend our heartfelt gratitude to our distinguished speakers, Shri Anshul Jain, CA Anup Kumar Agarwal and CA Vinod Kothari, for their structured, relevant and forward-looking deliberations. You have taken us through evolving financial asset classes, digital instruments, valuation complexities, regulatory challenges, and the transformation that technology is bringing into the financial ecosystem. Your lucid explanations and practical insights will certainly help the fraternity navigate this fast-changing landscape. I also thank our respected moderator, Mr. Rakesh Soni, for steering the discussion with such precision and ensuring that the session remained enriching, focused, and highly engaging. Thank you all for contributing to our meaningful deliberations. We now proceed to the next session of the conference. Thank you.